One of the interesting announcements on Monday is that Robinhood is getting into the presidential election market. And first time I saw this, I was wondering, what are we doing with Robinhood? Why is the company getting into something that should be more like a DraftKings kind of a product? But once you dig into it, this is actually a contract, or what's known as a swap, that's very common in financial markets. If you want to hedge some sort of a risk, maybe that's a commodity risk, maybe it's an interest rate risk, maybe it's a currency risk, that can be done in a number of different ways. One of those is through a swap contract, and that's exactly what this product is. So I want to go through the details on what it is, how things will be settled, and this could potentially be the kind of thing that Robinhood gets into more and more, especially as they're getting into more advanced trading products. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's look at the announcement from Robinhood. This is the announcement introducing the presidential election market. And you can basically just say, I want to buy a contract or a number of contracts that will pay out if Kamala Harris wins or if Donald Trump wins. Each one of these contracts pays out $1. So that's why you see here in this example, 200 contracts. And if Harris wins, you would get $200. So this, in this case, would cost you $102 to get this contract. So how exactly does this work? They actually outline this right here. Trading hours are going to be Sunday through Friday. And then on election day, trading is going to close. And then the contract actually doesn't resolve until January 7th when the candidate is certified in January. Very interesting little tidbit there, but the payout is not going to actually be until January. So what is this contract? They go through this in the FAQ. The event contract is what's known as a swap, and the contracts are a simple yes or a no. So you're buying actually a yes contract that Kamala Harris will win or that Donald Trump will win. And you can't own contracts for both candidates. I think that's an interesting tidbit as well. They don't want you to have a net positive position in both. And here's the great thing for Robinhood. If you're a Robinhood investor like I am, Robinhood charges a 1% commission per contract. So that's essentially a 1% fee for every single one of these contracts. Forecast X is going to embed the contracts so that the yes and no contracts add up to $1.01. So they're going to market make this so that the trading is equal on both sides, or at least in theory, that's what they're going to do. And then Forecast X is going to keep the 1 cent. Some of that fee is going to be kept by Robinhood. Forecast X is actually owned by Interactive Brokers. So that's another company that got into this market a couple of weeks ago. Obviously, that trading now extending to Robinhood. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So what in the world are the swap contracts that are behind this election product? Well, swap contracts are typically the kinds of things that are going to be traded by institutional investors or people who are trying to hedge risk in some sort of way. A very common thing to do is take a company that has a risk for a commodity of some sort of interest rate, and they're going to offload that risk to something like a hedge fund that's going to trade away that risk, is the way that you would actually do it. So let's say that you have interest rate risk. You have a floating interest rate. You're worried about that interest rate going up. A counterparty is going to say, we will swap an interest rate, a fixed interest rate, for the interest rate that you're going to get. Now, that counterparty is going to bet that it's going to be able to make money trading that interest rate, that there's going to be some sort of spread in what they're paying and what they're actually getting back. Credit default swaps were a very commonly used swap ahead of the financial crisis. So a credit default swap was seen as insurance in that case. So you pay a couple of percentage points betting that a company is or isn't going to default on its credit at the end of that contract, which would have a date associated with it, just like this swap has a date associated with it. The company is either defaulted or not defaulted. Credit default swap. And then that contract would pay out depending on the terms of the contract. This was all extremely complicated, especially before 2009. A lot of these things were kind of backroom deals. They were legal contracts, but the CFTC got involved at that point and built some frameworks and rules around it. That's where the frameworks behind this contract actually comes from. The CFTC has basically said, this is the kind of product that you can hedge. So yes, this may be the kind of things that the active day trader may want to just bet on the election, but there may be reasons that you would want to take a position for or against a candidate, depending on what your positions are in the market. Let's say that you're a big renewable energy investor, and they would be good for your investments if one candidate won, poor for your investments if another candidate won. That would be the kind of thing where having a credit default swap would take risk out of your portfolio. And that's what these products are fundamentally built for. But someone else is then taking the other side of that risk because maybe they have the opposite risk in their portfolio. So that's the kind of background, that's kind of the background behind this. These are products that have been around for a long time, but it's just typically not elections that we're using swaps for. Typically, it's products that would be traded much more on an exchange, like an interest rate, like currencies, like commodities. But there are things like credit default swaps that are based on an event. Does an event happen or not? And that's exactly what this falls under. So interesting move from Robinhood. I think this is one of those things that's just bringing more attention to the company, could potentially bring more assets to the platform as people want to make bets on this kind of a product. And as always, more assets on the platform, more trading that's happening on the platform is going to be good for Robinhood. And that 1% fee is going to be a nice kicker for Robinhood if it's able to bring new customers to the platform. What's going to be interesting to see is what's the growth of a company like Interactive Brokers, who's actually running this system and actually came out with the product first, versus a company like Robinhood, where it seems like they have much more momentum gaining assets. Could this be a much more popular product with them? You actually get customers, you actually get a disproportionate number of customers moving to Robinhood because of the simplicity of the trading on these new contracts. But hopefully that gives a little bit of background on exactly what's being traded. Swaps aren't the kind of normal thing that the average person trades, but maybe this is the kind of thing that we're going to see much more often, especially as Robinhood gets into more professional trading. They announced a couple of weeks ago they're going to have futures in some of their more advanced platforms. So you're going to be able to trade commodities, index futures, all kinds of different things that would typically be more exotic for investors. Swaps may be coming into the same market as well. But keep in mind, if you are interested in these kinds of products, there's typically someone else taking the other side of this risk. These are professional investors who aren't just betting on an outcome for something like a credit default swap or an interest rate. They're hedging risk. They have strategies behind it. They're not just guessing whether or not the Fed's going to raise interest rates or lower interest rates by 25 basis points in the next month or two. So interesting new product. I'm a little bit skeptical. So it's an interesting new product. We'll see if it really has any impact on Robinhood. Definitely isn't going to in their quarterly results, which are going to be released soon. I'm going to be covering that here on Asymmetric Investing, but maybe something that we hear more about after fourth quarter results. But let me know what you think about Robinhood's newest product in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.